And welcome and good afternoon to everyone, and thanks for joining. And thanks to LPPI for helping to bring this all together. So the background for the report that we released today, and it's available on our website at rfi.foundation, is looking at the economy-wide emissions in Indonesia and linking it to the different financial sector assets to identify where the concentrations of risk are and where the interlinkages are between different sources of financing and different emissions. It's the second of a series of reports that we're doing covering major Islamic markets, generally OIC countries with significant presence in Islamic finance. First report was on Malaysia, and we'll have some other reports coming up in a month or two on the UAE and Saudi Arabia. The reason we focused on these markets, besides the fact they align very much with our mission, is that there's insufficient data on these topics, not just looking at financial institutions on their own direct emissions, but primarily looking at what they're financing and what emissions result from that. And so from that report, we want to inspire people going in further on the data. Top-down data can be useful to point out where some of the major themes are, but each institution really needs to map it and contextualize it to their own context and what's material financially for it to be useful. But this should be a good starting point to support that further work. And I'm looking forward to some of the collaborations that we've discussed under the MOU, which was signed earlier. So the first point is, why are we focusing on greenhouse gas emissions from financed activities? And the main reason is that these represent a cost to the businesses that are being financed, and we heard some mention of this earlier, that are currently being unrecognized. So the Paris Agreement targets to keep warming well under 2 degrees and targeting 1.5 degrees. The emissions, business as usual, we have to see significant reductions. And one way or another, that's going to come as a result of it becoming more costly to emit. And there's a number of different ways on the right-hand side of this slide for how those costs will become internalized. But the main feature is that they will become a cost, and that will affect creditworthiness of companies receiving financing. That will ultimately affect financial institutions, and it will be a systematic impact because it'll affect economy-wide, financial sector-wide, and that's been one of the points that regulators, both in a national context or globally, have been very focused on, is the systemic risk impact. And the Paris Agreement, which we're looking out to 2030, includes features that make it get tighter over time. And so the 2021 to 2022 period is particularly critical for financial institutions, because in 2023, there'll be a global stock take that will really highlight whether or not we're likely to have an orderly or disorderly transition to reach the Paris Agreement targets. And by that point, investors, even more so than they already are, will be looking at what the companies and financial institutions that they own, or that they're providing loans to bonds and sukuk, what those financial institutions are doing to meet either scenario, the orderly or disorderly transition. So addressing that, putting it into the strategy, putting compensation targets for senior executives, as was mentioned, that CIMB does. All these things are going to be really important for maintaining investor confidence in financial institutions. Next slide, please. So I won't go through all this in detail, but generally what we've done here is take a top-down methodology. So we look at all of the emissions in Indonesia and all of the financial assets and map one to the other to identify what sectors and what parts of the financial sector are financing which sets of emissions. And then we do go dig in a little bit deeper, looking at what do those activities that are being financed, what emissions do those induce through their activities. So the example may be like an office building has its own direct emissions footprint, but it also is a user of electricity. It induces transportation demand. It creates waste that needs to be managed, and all of those have emissions footprints. And so we look at the both direct and indirect side, as well as the separate analysis looking at financing of household activities. So again, this is intended to give an order of magnitude estimate. It's based on a methodology developed by the French Agency for Ecological Transition. It's been piloted by several French banks, and we've added a few elements to it. Next slide, please. So there's within Indonesia, there's 4 sectors that are that account for the largest share of total emissions: agriculture, electricity, generation, transportation, and waste management. And I won't delve too much into these because we've already seen this mentioned in previous presentations. But of those 3, the electricity, transportation, and waste management are the ones that we focus on for the subsequent measures of indirect emissions. And we can go on to the next slide to look in more detail on this. The first point to make here is that the debt capital markets account for the largest share of emissions when you're looking just at the direct emissions, and that's due to large concentrations of electricity generation within the financed through the debt capital markets. And this is the important part about looking through to the indirect sources of emissions that are financed, because you see that the banking sector picks up a substantial amount of share of emissions when you consider both the direct emissions from what it's financing, as well as the induced demand for electricity primarily, but also transportation and waste management. That brings some of those emissions into the banking sector's overall footprint, which is important to look at when analyzing from the financial institution's perspective. How do they manage the finance emissions risk in the best manner? Next slide. So now we're looking more specifically within the banking sector, and of the greenhouse gas emissions attributable to banks in Indonesia, about half is coming from agriculture, and this is probably an underestimate because we're using greenhouse gas data that excludes land use change, and forestry. So if anything, there's probably a likely higher share of emissions attributable to agriculture. But then with the remaining half, on the left side, it's the direct emissions, the emissions footprint of what's being financed, whether that's manufacturing or other sectors, construction. And on the right-hand side is pulling in some of the indirect emissions that go into those directly financed sectors. So for construction, it's bringing in electricity generation that is induced through construction, as well as the waste management that's needed. So this really focuses and highlights sort of the different ways to look at the data, and how to map where banks financing is going to in terms of its greenhouse gas footprint. Next slide, please. And this is on the household financing. So that's about 15% of overall greenhouse gas emissions in Indonesia are attributable to household financing. And the reason we do this separately is because we didn't want to we wanted to avoid double counting within the other estimates. So the previous estimates were a production view. So you look at the emissions footprint of financing a car factory, but then you'd want to look at the emissions attributable to those vehicles purchased by consumers separately, so that you're not double counting. And what on this, we're showing the difference between the share of emissions attributable to conventional banks and to Sharia banks. And transportation is the largest overall source of emissions attributable to household financing. But as this shows, on a relative basis, the share of emissions out of all the residential property emissions that are financed, Sharia banks actually tend to have higher shares of those emissions attributable to their financing. And there's many explanations possible, but one of the, I think, most the simplest explanation is that it's easier to arrange the transactions in a Sharia compliant way with property, and so that may draw some additional financing assets for property into Sharia banks, which provides them with that being one sort of differentiation of where they should focus their efforts on emissions reduction, is looking at not just the largest sources of emissions or where they're financing activities that induce the most emissions, but also where on a relative basis are they financing more than their overall share in the financing assets. Next slide, please.
You have 3 minutes left.
Thank you. And this slide and the next slide show the differences where the emissions are coming from on a relative basis between Sharia banks and conventional banks, and largely it's again in the real estate and the other business sectors that Sharia banks have more of a concentration of their financed emissions, whereas conventional banks, it's more from manufacturing and agriculture. And doesn't change a lot when you go to the next slide to see the picking up the induced emissions as well. But next slide, please. It doesn't change much in terms of qualitatively, except there's some measure of the movement of emissions attributable to banks from debt capital markets, as I mentioned earlier. Next slide, please. And this is showing the number of owners, of investors in banks that are either have a climate policy of some kind or are signatories to the Principles for Responsible Investment or Principles for Responsible Banking. And it's just showing the importance of climate and ESG issues from an investor perspective. That makes it really important for banks to take into consideration. Next slide. So this is just there's 3 key areas where we see recommendations in our report. One is that the financial institutions need to analyze their emissions footprint, both directly of their own activities, but more importantly, on what they're financing and what emissions are coming out of those activities. And the reason is because if you're financing renewable energy, for example, but then you're also financing very energy intensive and growing intensivity sectors, you're effectively canceling out the effect. And if you focus on where there can be complementary efforts, energy efficiency financing, as well as renewable energy financing, then it increases the impact and it mitigates faster the financed emissions risk. And we heard about some of the policy support that is coming around finding points where there's incongruous policies in different areas and smoothing those out so that they all move in the same direction towards Indonesia's overall climate objectives and commitments. And the taxonomy, which was mentioned, is very important that it be a science-based taxonomy to classify green assets, and that builds the opportunity. So as banks are able to tag more green assets and sustainable assets, they're able to use that to tap sustainable capital markets with sustainability linked bonds and sukuk. And there's other opportunities to expand blended finance to make more opportunities bankable in climate change adaptation to help meet the overall climate objectives. And with that, I'll wrap it up.